Greetings, fellow silver and gold stackers. Today marks the start of our silver giveaway. We have 20 ounces of silver ready to go to one lucky participant. Entering is simple. Like this video, comment your preferred form of silver or your 2026 price forecast, and subscribe to the channel. That's it. At the end of January, we'll select a winner live, and 20 ounces of silver could be yours. Last month, 10 ounces were given away, and it's astonishing how easy it is for anyone to participate. Even a child could do it. Just share your thoughts, like, comment, and subscribe. It's that straightforward. We're grateful for your continued support, and these giveaways are our way of giving back. Now, let's get into the heart of today's discussion. We have a very special guest, Keith Weiner, founder and CEO of Monetary Metals. Keith, thank you for joining us today. We appreciate you taking the time. Happy to be here, Keith responds. We're diving straight into the recent flurry in the precious metals market, particularly silver and gold. Many of you have made predictions about 2026, and some of them have already proven accurate. But what's happening right now? What's driving the market? And what should stackers like us be paying attention to? Keith points out that, although some investors are surprised by current market movements, those of us actively involved in precious metals see the excitement coming. He mentions the rising co-basis in gold, which is capturing his attention. For context, the co-basis measures scarcity versus abundance in precious metals and helps identify the relative rarity of silver or gold. Typically, in commodities, high prices reduce demand. But with precious metals, the dynamics are unique. Gold and silver have been stockpiled for centuries, far longer than almost any other commodity. Gold has been stored for over 650 years, and silver has a similarly long history of accumulation. This means we have enormous reserves, yet scarcity is still a critical factor on the market. Keith explains backwardation, a situation where future prices are lower than current prices, indicating hesitation among sellers. Using a simple analogy, imagine trading a silver bar for a paper contract that guarantees delivery months later. The trade seems risk-free, but there's always a hidden danger, especially if counterparties fail to deliver. This is a reality for silver and gold traders and underlines why physical ownership matters. Backwardation isn't a sign of scarcity alone. It reflects market trust, confidence, and operational complexity. When people stop trusting one another, prices react in ways that paper markets alone can't explain. Keith emphasizes that silver and gold aren't typical commodities like wheat or copper. They function as money, with reserves accumulated over millennia. Additionally, Keith notes the strategic significance of silver in recent geopolitical and trade contexts. For example, tariffs and international policies can disrupt the New York to London arbitrage, affecting how silver moves between markets. This could impact pricing, availability, and market behavior, which makes monitoring co-basis and backwardation even more critical for informed investors. For stackers, this is thrilling. People are already predicting silver at $100 or even $150 an ounce, with gold potentially reaching $5,000, $6,000. While extreme, these figures highlight the potential of current market conditions. It's not just speculation, it's the interaction of scarcity, confidence, margin, and global demand that drives these moves. Before we continue, remember, the silver giveaway is open now. Enter by liking, commenting, and subscribing. 20 ounces could be yours, so don't miss this opportunity. Let's dive deeper into the mechanics of silver and gold markets. One key factor driving recent movements is backwardation. As Keith explained, backwardation occurs when the spot price is higher than future prices. In simple terms, people want the metal now more than later. This is unusual for typical commodities, but common in precious metals. reflecting scarcity, confidence, and market behavior. Backwardation often signals market stress. Traders may hesitate to sell physical metal because they're unsure if they can replace it later. In silver, we've seen a mild backwardation, not massive, but enough to indicate that participants are cautious. For investors, this is a warning. The market isn't always about paper trades. Physical ownership matters. Keith gives a practical analogy. Imagine a silver bar you own. You trade it for a paper contract promising delivery months later. On paper, it seems risk-free. No margin calls, no solvency issues. But if the counterparty defaults, your metal might not return. This is the hidden risk in paper markets. It's why stacking physical silver and gold is essential. Meanwhile, gold shows similar trends, but with less dramatic backwardation. The co-basis for gold has been rising steadily, signaling increased demand relative to supply. Co-basis measures the gap between spot and forward prices and serves as a reliable metric for metal scarcity. Rising co-basis suggests that investors increasingly want immediate possession of gold rather than promises for future delivery. Another layer affecting markets is margin calls on futures exchanges, like the CME. When volatility rises, margin requirements increase. That's standard procedure. Exchanges need to ensure participants can cover potential losses. The day before Christmas, silver surged from $71 to $79 per ounce. Shortly after, margin calls triggered a 10% drop in a single day. The movement wasn't arbitrary. It was the direct result of mechanical adjustments in leverage and risk management. Margin calls don't necessarily cause prices to fall permanently. They create temporary volatility. When traders holding short positions are forced to cover, or when leveraged positions adjust, the market experiences rapid swings. Yet these swings are often followed by reversals, because the underlying demand for physical metal remains. Keith also highlights the role of arbitrage. For example, a refiner or bullion dealer may hold significant physical metal and short futures contracts to hedge. The short positions appear on paper, but the physical holdings are invisible in exchange records. This disconnect can amplify apparent market stress. The actual metal is there, but the paper contracts create noise and volatility that misleads casual observers. Globally, institutional involvement is increasing. Unlike retail buyers, institutions analyze markets through co-basis, backwardation, and futures dynamics. Many are positioning strategically, leveraging both physical holdings and hedges. Retail investors can learn from this, understanding that the market is coordinated but complex. It's not just about predicting the next price spike. Geopolitical factors also influence silver. Strategic mineral designations, potential tariffs, and cross-border arbitrage impact availability and pricing. For instance, New York-London silver flows can be disrupted if trade policies change. This adds a layer of uncertainty for traders relying on seamless international movement of metal. Finally, confidence is paramount. Precious metals aren't just commodities. They're money and a store of value. When faith in counterparties or governments declines, demand for physical metal rises. Paper markets respond with volatility, but true scarcity is revealed in what participants actually hold. In summary, backwardation, co-basis, margin requirements, and arbitrage interact to create a market that's unpredictable on paper, but logical when viewed through the lens of physical metal. For stackers, understanding these dynamics is crucial. It's not about chasing daily price swings. It's about knowing why the market behaves the way it does, and positioning to benefit from long-term trends in scarcity, demand, and confidence. Now let's break down the mechanics of hedging and futures in the precious metals market. Many participants, including refiners, mints, and bullion dealers engage in hedging strategies to manage risk. They hold physical metal while taking short positions in futures contracts. This seems counterintuitive to casual observers. Why sell metal you already own? The answer is price risk management. For example, a refiner holding silver may sell a futures contract for delivery months ahead. If prices drop, the gain on the futures offsets the loss in their physical inventory. Conversely, if prices rise sharply, they might face margin calls, but these are predictable and manageable for seasoned operators. The short futures act as a financial shield, stabilizing operations while maintaining ownership of physical metal. This hedging creates an illusion of scarcity or oversupply in paper markets. Many people see large short positions and assume metal is missing, but in reality, the metal is sitting in vaults or storage, quietly hedged. The futures market records contracts, not the physical metal, which can mislead inexperienced traders into thinking there's manipulation or shortage. The jewelry market adds another layer of complexity. In Western countries, jewelers often carry modest inventory, designed more for retail sales than investment. Contrast that with Turkey, India, or the Middle East, where buyers prefer heavier, high-purity pieces. Jewelry in these regions represents both personal wealth and a quasi-investment. When prices rise, jewelers there are less concerned with margin calls because their customers pay in full, and they can hold metal without immediate liquidity pressure. High metal prices, however, affect supply chains everywhere. Miners, refiners, and mints often borrow dollars to fund inventories. If prices surge, their borrowing costs increase, and hedges must be adjusted. This can amplify volatility, especially if multiple parties are hedging simultaneously. The resulting price swings are not manipulation. They are a natural consequence of a highly leveraged, globally interconnected market. Institutional investors are now dominating these dynamics. Since 2013, monetary metals has observed a shift. While retail participation is modest, institutions are actively buying and hedging. They combine physical accumulation, futures contracts, and co-basis analysis to manage exposure. This differs sharply from the period following the 2011 peak, when everyone was liquidating positions. Today, long-term strategy prevails over short-term speculation. Backwardation interacts with hedging in important ways. When the spot price is higher than futures, holders of metal can profit by leasing it or trading it temporarily, further tightening available supply. This explains why backwardation persists despite rising prices. The market signals immediate demand is outpacing the ability to deliver physical metal later. Another global factor is arbitrage between regions, especially New York and London. When tariffs or trade policies change, flows of silver and gold can be disrupted. Arbitrage opportunities appear, but institutional investors carefully weigh shipping costs, margin requirements, and geopolitical risks before acting. This prevents widespread exploitation by casual traders and keeps the market more orderly than it might appear on charts. Finally, confidence drives the market. Precious metals are stores of value, not consumables. When trust in currencies, governments, or counterparties declines, demand for immediate possession of metal rises. The paper market reacts with volatility, backwardation, and exaggerated moves, but the underlying reality, physical metal in storage, remains stable. In short, hedging, futures, jewelry dynamics, global arbitrage, and confidence all interact to shape silver and gold markets. Understanding these factors is critical for stackers and investors. It's not enough to watch charts. You must grasp how physical metal, paper contracts, and global behavior intertwine to influence pricing and availability. Let's dive deeper into leasing programs and margin mechanics, which are shaping how gold and silver operate as both investments and working capital. Physical metal sitting idle is a missed opportunity. Institutions and high net worth stackers now use leasing arrangements to earn yield on their holdings. For example, an authorized investor can earn 2 to 5% on gold, or up to 12% on silver, paid in physical metal. This isn't speculation. It's simply putting otherwise idle metal to work while retaining ownership. Leasing also impacts market liquidity. When metal is leased, it can be used to settle contracts, meet delivery obligations, or support hedging strategies. This reduces stress on physical supply chains without selling metal outright. In other words, leasing keeps metal productive while keeping it in circulation, which can alleviate certain backwardation pressures but not eliminate them entirely. Now, consider margin calls on futures exchanges like CME. When volatility spikes or prices surge, exchanges are required to raise margin requirements. This is not punishment. It's a protective mechanism, ensuring that participants can cover potential losses. The sudden increase before Christmas, for instance, caused dramatic price swings. Silver rose from $71 to $79 before dropping sharply. It wasn't manipulation, it was risk management at work, enforcing solvency and protecting the clearinghouse. Many misunderstand the effect of margin increases. Some assume higher margins push prices down, but the reality is more nuanced. Market participants are heterogeneous. Some hold physical metal, some are short futures, some hedge. As margin requirements rise, each group reacts differently. Hedgers may need additional capital, while unhedged traders may be forced to close positions. This creates discoordination, not guaranteed price decline. Prices can move unpredictably despite higher margins, especially in thinly traded or highly leveraged periods. Discoordination is a recurring theme. Off-takers with multiple mines may need to sell forward to meet cash flow obligations. When margin requirements rise, some may have to delay hedges, partially close contracts, or raise operating capital, which introduces volatility. Market structure, not manipulation, explains much of what casual observers perceive as chaos. Institutional behavior amplifies this effect. Unlike retail investors, institutions plan strategically. They combine leased metal, hedging, and careful cash flow management to navigate volatility. Jewelry markets further complicate dynamics. In the West, retail jewelers carry small inventories. In contrast, markets in Turkey, India, and the Middle East favor heavy, fully paid gold, which allows dealers to hold large physical positions without relying on paper hedges. Backwardation remains a critical indicator. When spot prices exceed futures, holders can profit by trading physical metal temporarily, leasing it, lending it, or delivering it against contracts. This tightens short-term supply and keeps backwardation intact even during a price rally. Understanding this is crucial. High prices alone don't remove backwardation. It is driven by immediate delivery demand versus future delivery supply. Global arbitrage adds another layer. Movement between London, New York, and Asian markets is impacted by tariffs, trade policy, and shipping costs. Even a small policy shift can disrupt flows and temporarily distort prices. Traders must weigh logistics, capital costs, and geopolitical risk before acting, which prevents casual exploitation. Finally, confidence drives demand. Precious metals are both a store of value and a medium of exchange. When trust in currencies or financial systems declines, demand for immediate possession rises, futures markets react, backwardation appears, volatility spikes, but the underlying reality, metal in vaults, remains stable. In essence, leasing, margin mechanics, arbitrage, and global demand interact to produce the complex price behavior seen in silver and gold. Stackers who understand these forces gain an advantage, recognizing why market moves are sometimes counterintuitive and why physical metal remains the ultimate store of value. As we wrap up, let's focus on what all of this means for stackers, investors, and the overall precious metals market. One of the clearest lessons is that high prices don't automatically resolve market imbalances. Backwardation, leasing activity, and margin requirements interact in ways that create volatility rather than smooth pricing. Even when silver or gold rises dramatically, the fundamental dynamics, supply constraints, immediate delivery demand, and institutional hedging remain unchanged. For stackers, this is a crucial point. Holding physical metal protects against systemic risks. Unlike paper contracts, physical ownership ensures you are insulated from margin calls, defaults, or clearinghouse complications. The recent holiday price swings demonstrate why physical possession matters. Traders, relying solely on futures or leveraged positions, faced potentially devastating losses in just a single day. Those holding metal in secure vaults or through reputable leasing programs were largely unaffected. Leasing programs are particularly noteworthy. By lending metal to authorized participants, stackers can earn a modest but steady return, 5% for gold, up to 12% for silver, without selling. This approach keeps your metal productive while preserving ownership. The market benefits too. Increased liquidity in the short term helps reduce extreme backwardation and supports smoother delivery flows. It's a win-win for those who understand the mechanics. Institutions have learned to navigate this landscape effectively. Unlike retail investors, they combine leased metal, forward hedging, and careful cash flow planning to survive periods of high volatility. They can absorb margin increases because their strategies are diversified and they plan for multiple scenarios. Retail stackers can take a page from this playbook by being disciplined, maintaining proper storage, and understanding the difference between paper speculation and physical metal investment. Global factors amplify the dynamics. Arbitrage between New York, London, and Asia is sensitive to tariffs, trade policy, and shipping costs. Even modest disruptions can distort prices temporarily, creating opportunities, but only for those who understand the operational realities. It's not enough to just see a price spike. You must consider availability, delivery time, and cost of capital before acting. Another takeaway is the psychological element. Confidence, or the lack of it, drives short-term demand. When trust in currencies falters, people rush to acquire physical silver and gold. This is why backwardation appears during periods of high uncertainty. Markets may rise or fall rapidly, but the underlying stockpiles of metal remain stable. Understanding this allows stackers to act with clarity rather than panic. Looking forward, volatility is likely to continue. Institutional interest in 2026 is increasing, Western retail engagement may lag, and emerging markets continue to prioritize physical accumulation. Combined with macro pressures like currency depreciation, inflation, and geopolitical uncertainty, silver and gold markets are poised for continued activity. High prices will not discourage demand. If anything, they reinforce the value proposition of holding metal. Finally, practical advice for stackers. Focus on security, liquidity, and education. Understand leasing programs, monitor backwardation, and differentiate between paper derivatives and real metal. Don't rely on instant price fixes or simplistic theories that margin calls always lower prices. Instead, take a long-term view, recognizing that volatility is part of the landscape and physical metal is the anchor. So, whether you're entering our 20-ounce silver giveaway or simply expanding your stack, remember, knowledge, discipline, and access to physical metal are your best defenses. Watch the markets, understand the forces at play, and make strategic decisions rather than emotional ones. Thank you for joining us on this journey through the intricate world of silver and gold markets. Stay vigilant, stay informed, and keep stacking. Follow us on Instagram and X for daily updates, and check out resources like Monetary Metals to deepen your understanding. This is how serious stackers protect themselves and thrive, by combining education, prudence, and physical ownership. Until next time, stay safe, stay prepared, and keep your eyes on the metals.